Okay, welcome back, and we will be continuing with the new sums section from Index 116. There are two questions in terms of being added over here, both of them from the RTP. The first question involves separation of a lease and a non-lease component, and the separation, the allocation as per Index 116 happens in the ratio of the standalone prices. So in case standalone prices are given, you will allocate the transaction price, the total price that you are paying, in the ratio of the standalone prices, and the lease liability will obviously calculated only for the lease component, and the non-lease component will be recognized as and when the expense is incurred. Sir, what do you mean by lease component and non-lease component? To be very clear, let us say you hire just a car. Then car is an identified asset, in which case there is only a lease component. However, if you hire a car along with a chauffeur or a driver, in which case there is a lease component whereby you have hired a car and the services of a driver, which is a non-lease component, it is a service. And hence you can either recognize the services of the driver expenses separately and the car lease separately, or there is a choice which is given whereby you can combine the lease and the non-lease component. However, this is not a mandatory requirement, it is optional. So in case a separation is required, in which case you will recognize the car lease separately and the driver's expenses separately. If no separation is done and that is given in the question, then you will recognize only the car, nothing relating to the driver separately. In any case, if a separation is needed, the allocation is going to be in the ratio of the standalone prices. Okay, considering that background, we'll go to question number 1. Okay, entity X, who is the lessee, entered into a lease agreement with entity Y, who is the lessor, to lease an entire floor of a shopping mall. So there is an identified asset, that is a floor of a shopping mall, for a period of 9 years. That is the lease term. The annual lease rent of rupees 70,000 is payable at the year end. At the end of each year, 70,000 is paid for the floor. This is as per the agreement. To carry out its operation smoothly, X simultaneously entered into another agreement, that is a facilities agreement, that whereby it is getting facilities or services with Y for using certain other facilities owned by Y, such as passenger lifts, DG, that is generator sets, power supply infrastructure, parking space, etc. So these are basically services, facilities. There is no identified asset, and hence this is like a non-lease component. Whereas this is a floor of a shopping mall whereby there is an identified asset and hence there is a lease component. Okay. Which are specifically mentioned in the agreement for annual service charges amounting to 1 lakh. So we have agreed to pay 70,000 for the floor and 1 lakh for the facilities. As per the agreement, ownership of the facilities will remain with entity Y, and lessee's incremental borrowing rate is 10%. So if there is no separate lessors IRR available, this will be taken as a discount rate. Okay, the facilities agreement clearly specifies that it shall be coexistent and coterminous with the lease agreement. So it will continue as long as the lease agreement continues, which seems to be 9 years. The facilities agreement shall stand terminated automatically on the termination or expiry of the lease agreement, which is after 9 years. Entity X has assessed the standalone price of the lease agreement is 1,20,000. Now, as per the agreement, you are paying 70, but that does not really matter. As per the agreement, you can say that it is free as well, the entire floor. That does not really matter. Okay. And the standalone price of the facilities agreement is 80,000. So this is if you had entered only the lease, you would have paid, let us say, 1,20,000. If you would have entered into only facilities, you would have paid 80. Okay. Maybe if you are taking both of them, you might get a combo discount as well. Entity X has not elected to apply the practical expedient. Not elected to apply the practical expedient. That means a shortcut as per paragraph 15 of Index 16 to not separate the non-lease components from the lease components, and accordingly. So it has not taken the choice to combine them. Basically, that means it has taken a choice to show them separately. So if nothing is given, you will always show them separately only. And accordingly, it separates the non-lease components from the lease components. How will entity X account for the lease liability at the commencement date? Well, lease liability is the present value of future cash flows, but these are future cash flows which are attributable to the lease component. As per the agreement, you are paying a total of 70 for the floor plus 1 lakh for the facility. So you are paying a total of 1,70,000. But can we say that that means 70 is attributable to the lease, whereas 1 lakh is attributable to the facilities? No. The allocation has to be in the ratio of the standalone prices. And the standalone price for the lease component or for the floor is actually 1,20,000. The standalone price for the non-lease component, that is the facilities, is actually 80. And hence ideally you should have paid 2 lakhs, but you're not paying 2 lakhs. You're actually paying 1,70,000. And hence the fair allocation to the lease as well as the non-lease component would be, well, 1,70,000 to be attributable in the ratio of 120 by 200, 1,70,000 to be attributable in the ratio of 80 by 200, that is in the ratio of the standalone selling prices. In which case this is 1,70,000 into, let us say, 1,02,000. So this comes to 1,02,000, and the remainder, I guess, is 68,000. You can do that working as well, is attributable to the non-lease component. We have decided to separate them out, and as a result, for the facilities, Ind AS 116 will not apply. Regular accounting standards will apply, whereby you will recognize the expense as and when incurred. That is 68,000 will be recognized as an expense as and when it is incurred. However, the remaining 1,02,000 you will create a lease liability. Lease liability will be created for 1,02,000. Sir, I'm 170 pay kar rahe. Yes, you might be paying 170, but out of that 68,000 is for the services, for the facilities. The remaining 1,02,000 is for the lease. This is paid over a period of 9 years. The discount rate should ideally be the lessor's IRR, but if that is not available, the lessee's incremental borrowing rate. So this is 1 divided by 1.10. 1, 2, 3, 4, 5, 6, 7, 8, 9. So we can take 5.7590. If we multiply this, 1,02,000 into 5.759 comes to, I guess, 5,87,418 approximately will be the value of the lease component. 68,000 will be recognized as expenses as and when they are incurred. So this is 586,316, approximately the same, 587,316, and 68,000 will be allocated and recognized in the P&L as and when it is incurred. Sir, what if the question had told us that we decide not to separate the lease and non-lease? Then we would have taken the entire 1,70,000 as the lease component, and 1,70,000 into 5.7590 will be recognized as the lease liability. There will be no separate lease component. That is if a choice is specifically taken. Sir, if nothing is given, we'll always assume that you will separate. No separation, question has to specifically tell you. Okay. That is question number 1. Next, you go to question number 2. Over here, this is a foreign currency lease. Well, if it's a foreign currency lease, so be it. Ind AS 21 on foreign exchange will also apply. Remember, what is a monetary item? A monetary item is an item whereby you have a contractual right or a contractual obligation to pay or receive a determinable amount. So a lease liability, you have to contractually pay a determinable amount, and hence the lease liability is a monetary item. However, the right of use asset is a non-monetary item, and non-monetary items will be recognized at historic rate. Depreciation will be based on that rate only, whereas lease liability will be restated at each balance sheet date at the closing rate. Interest or finance cost is an expense which will be recognized at the average rate. Lease payment is an actual payment, will be recorded at the date when the payment happens. So taking all of that into consideration, we will go to question number 2. This is an interesting question. I would rate this as important. A combination of Ind AS 21 and Ind AS 116. Entity X is an Indian entity whose functional currency is the rupee. Okay. It has taken a plant on lease from entity Y for 5 years for its manufacturing process, for which it has to pay an annual rental of USD 10,000 every year. Okay. On the commencement date, the exchange rate was USD 68 per dollar, rupees 68 per USD rather. The average rate for year 1 was 69, and at the end of year 1, the exchange rate was 70. So average rate 69, closing rate 70. The incremental borrowing rate for entity X on the commencement date for a USD borrowing was 5%. So we have been given the discount rate. How will entity X measure the right of use and lease liability at the end of year 1? Right of use, remember, is a non-monetary asset, whereas a lease liability is a monetary asset. So a non-monetary asset will be based on the historic rate, that is the rate at the initial recognition, that is 68, whereas the monetary liability will have to be restated at the closing rate. First of all, you have to find the value at year 0. At year 0, this is $10,000. We can take the present value annuity factor at the rate of 5% for a period of 5 years. So this is 1 divided by 1.05, 1, 2, 3, 4, 5. You can even prepare a separate table if you want to. 4.3295, let us say. So this is 10,000 into 4.3295 will come to 43,000. 43,295. This is your lease liability in dollars along with the ROU asset. Acha, if you were to convert this is a value at year 0, so you will have to convert it at the exchange rate prevailing at year 0. This is 68 per dollar. This is the value at year 0. So into 68, and this will come to, let us say, rupees 29 lakh 44,060. Sir, that's it. The question asks you to find lease liability and ROU asset. That is at the end of year 1. This is a value at the start of year 1. ROU asset account debit 29.44 lakhs to lease liability 29.44 lakhs. Acha, going forward, how will things change? When we look at ROU asset at year 0 would be 29,44,060. The useful life is a period of 5 years, and hence the depreciation would be 29,44,060 divided by 5 into 1. So this is divided by 5. So this is 5,88,812, and as a result, your value at the end of year 1 would be 23,55,248. It's a non-monetary item. Whereas when you look at the lease liability, well, the working will be very similar to what you do in financial instruments, which are measured, let us say, at amortized cost along with the lease along with a financial liability. What you do is you first do the working in USD and then convert each of those components into rupees. So when you look at the opening balances, so this is year, let us say 1, the opening balance is 43,000 in dollars. 43,295. 43,295. We have given the working at the top as per ICAI working. However, you can do the working that I'm suggesting over here as well. The finance cost or interest will be at the rate of 5%. So this is 43,295 into 5%, which will be $2165. I'm just rounding off, $2165. Apart from that, there would be a lease payment at the end of the year, which is at $10,000, and hence this will give you a closing balance in dollars, which is 43,295 plus 2,165 less 10,000, and hence your closing balance in dollars would be 35,460. You will convert each of these items at the respective rate. So this will be converted at 68 per dollar. This is throughout the year, and hence at the average rate, that is 69. The payment is made on the last day, that is 70, and being a monetary item, the closing balance will also be converted at the rate of 70, which means if we look at the balances in INR, this will be years 1, the opening balance in INR, which is 43,295 into 68, 29,44,060. Finance cost, this will be at the average rate. So this is 2,165 into 69, 149,385. The lease payment, which is made at the end, so this is 7 lakhs, 10,000 into 70, and hence ideally your closing balance based on these workings should be 23 lakh 93,445. However, your actual closing balance as per Ind AS 21 principles is 35,460 into 70. So this is 24 lakh 82,200. Sir, why is it different? Well, ideally it should be the same. However, why is it different? Well, because you have used different exchange rates. Opening you have taken 68, interest you have taken 69, lease payments and closing you have taken 70. if the numbers were tallying in dollars, they would have been also tallied in rupees. Had you taken a uniform exchange rate, you took different exchange rates, and hence that is the source. So this is the source, the different exchange rates, and hence this will be a forex. What? Loss or gain? Well, if you have to increase the liability, you'll have to credit the liability. Well, you have to credit the liability, forex loss will have to be debited. So this is the forex loss, and this will be taken to the profit and loss account. This will be calculated as the balancing figure between 93,445 and 24,82,200. So this will be, let's say, 88,755, which will be the foreign exchange loss. So the question asks you that what will be your closing balance of the liability, which will be 24,82,000, and your ROU asset 23,55,248. Here you go, ROU asset 23,55,248, roughly a slight degree of approximation, and your lease liability closing, if you go to see, will be 24,82,550, 24,82,200, approximately the same. Okay, so you can use this method to solve as well. So that takes care of question number 2, lease question. Apart from that, lease mein there is one more change which is there in the amendments, whereby the last date for availing the practical expedient rent concession, which was earlier 30th June 21, is now amended to 30th June 2022. That is it. Okay, next you have Ind AS 23, which is on borrowing cost. This is a question of May 21 RTP, where you have calculated the borrowing cost to be capitalized based on effective interest rate. In almost every question you have, you take the coupon rate as your real rate. However, if an effective rate is specifically given to you in the question, then the capitalization is based on the actual finance cost you calculate, which is based on the effective rate of return. So this is Ind AS 109 and Ind AS 23 combined. Okay, let us look at question number 1. Okay, how will you capitalize the interest when qualifying assets are funded by borrowing in the nature of bonds that are issued at a discount? Well, you will capitalize the interest for qualifying assets which are taking a substantial period of time, in which case the borrowing cost during the period of construction will be capitalized, and the borrowing cost will be calculated based on the effective interest rate into the opening balance. That is using Ind AS 109 techniques for amortized cost. Okay, Y Limited issued at the start of year 1 10%, that is interest is paid annually, having a maturity period of 4 years, bonds with a face value of 2 lakh rupees at a discount of 10%. So your issue price would be 2 lakhs minus 10% will be 1 lakh 80. Okay, to finance a qualifying asset, question clearly tells you which is ready for intended use at the end of year 2. It will take 2 years for the asset to be ready for its intended use. Compute the amount of borrowing cost to be capitalized if the company amortizes discount using an effective rate of 13.39% as per EIR. Well, the borrowing cost to be capitalized will be the borrowing cost for the first 2 years. Your opening balance of the liability is 1 lakh 80. This has to slowly move over 2 years to probably the redemption value, that is 2 lakhs. And hence for that an effective interest rate at the rate of 13.39%. Sir, the coupon rate is only 10%. Okay, that is 10% on the face value. You have not received the entire 2 lakhs. You have received only 1 lakh 80. So this is 1 lakh 80. However, your real cost is much higher, because you, apart from the coupons each year, you also have to pay a slightly higher amount on redemption as compared to what you have received. So this is 24,102. And coupon is paid on each year. Coupon is a percentage of face value. So this is 2 lakhs into 10%, and hence the closing. The principal is not repaid now, and hence the closing would be, let's say 1,84,102. That will be the opening for the bond into, let us say 13.39%, which will be 24,651. Just for academic completion, you can, let's say, subtract 20,000 and you will get a closing. This is around 1,88,753. So over the 2-year time frame, the borrowing cost to be capitalized will be 24,102 plus 24,651, which is 48,000. 753. This is the borrowing cost to be capitalized. Sir, why only for the first 2 years? Does the bond redeem after 2 years? No. The bond continues, but the asset is ready for use. And the moment the asset is ready for use, capitalization will stop. So over here, 48,753 is the borrowing cost to be capitalized over the first 2 years. Achha, next is question 2. This is in November 21 RTP. This is similar to a question that you had in your Inter CA under AS 16, whereby you were taking a loan not for acquisition of an asset but for a renovation of an asset. Okay, so can renovation also be considered to be qualifying? Well, yes, if the renovation takes a substantial period of time. If it takes a substantial period of time, then even that is considered to be qualifying. And substantial period of time, unless otherwise given, is a period of 12 months. Okay, so considering that, we will read this question. Question number 2. ICAI Limited, you can mark this as important. ICAI Limited has obtained a term loan of 620 lakhs for a complete renovation and modernization of factory. So the objective of this loan is a renovation and modernization of the factory. As on 1st April 2011, the plant and machinery was acquired under the modernization scheme. So you have acquired this machinery under the modernization scheme, and installation was completed on 30th of April 2012. Mind you, look at the years. This is 11 when the loan was taken, and you have acquired the plant, but the renovation exercise took so much time that it was fully installed after doing all the necessary changes on 30th of April 2012. That is a good 13 months later. An expenditure of 510 lakhs was incurred on installation of plant and machinery. Okay, so the loan was 620, out of which 510 was for the plant and machinery. 54 lakhs has been advanced to the suppliers for additional assets. So maybe certain assets suppliers are making for you, and these assets cost you 54 lakhs. These are acquired on 25th of April 2011. Okay, 11, which were also installed on 30th of April 2012. That is a good 1 year and 5 days later. And the balance of 56 lakhs has been used for working capital purposes. Okay, working capital means day to day, cash, stock, debtor, etc. management. Okay, so typically the amount which is spent for working capital will not be a qualifying asset unless it is otherwise given. The amount which is spent for plant and machinery will be considered to be an amount spent for a qualifying asset because it took 13 months to be ready for the use. Installation took 13 months. And for the 54 lakhs, you have not constructed these additional assets. However, these additional assets were acquired on 25th of April. But again, in order to do the renovation, the modification, it took 1 year and 5 days. And hence, this can also be taken as a qualifying asset. It took more than 1 year. 1 year and 5 days. Okay, so is the funds fully utilized? Well, let us see. 620 was the amount of term loan, out of which 510 was used for the plant and machinery. 54 was advanced to the suppliers for additional assets, and 56 for working capital. So if I take 620 minus 510 minus 54 minus 56, perfect. So there is no other end use for this loan. Management of ICAI considers the 12-month period as a substantial period of time to get the asset in the ready to use condition. Well, 12 months is not mandatory. However, if nothing is done, we can take 12, and here the question specifically tells you that 12 months is the time period which is considered to be a substantial time period. The company has paid a total interest of 68.2 lakhs. Maybe 11% is the rate of interest on the loan. So 68.2 lakhs, whatever it is given to you. During the financial year 11-12, on the above loan, the accountant seeks your advice on how to account for the interest in the books of accounts. Okay, now this entire 68.2 lakhs cannot be taken towards the qualifying asset because working capital is not, and the 68.2 cannot entirely be expensed to the P&L because, well, a part of it is towards the qualifying asset. Okay, the accountant seeks your advice on how to account for the interest in the books of accounts. Will your answer be different if the whole process of renovation and modernization is completed on 20th of February? If it is completed on 20th of February, it is completed within 11 months. If it is completed within 11 months, then it is not a qualifying asset, and in such a case, the entire 68.2, whether it is working capital or other than working capital, can go to the P&L. Aja. So, two parts. In the first part, you can say that the amount which is spent towards plant and machinery This will be capitalized, the borrowing cost. How do we calculate that? Well, 68.2 into 510 out of 620. Second is the amount spent towards additional assets, which will also be capitalized, which is 68.2 into 54 upon 620. And lastly, working capital. I mean, one can also assume working capital takes substantial period of time, but unless given otherwise, institute has assumed that it will not take a substantial period of time, in which case this will be expensed. This will be 68.2 into 56 upon 620. So this will be 68.2 into 510 upon 620, 56.1 capitalized, 54 in 68.2 into 54 upon 620, 5.94 capitalized, 68.2 into 56 upon 620, 6.16 expense to the P&L account in scenario A. In scenario B, the entire 68.2 will be expense to the P&L account because none of them are a qualifying asset. You can still allocate if you want, but ultimately in scenario 2, everything will go to the profit and loss account. Just to verify, yes, 6.16 will be expensed and 56.1 plus 5.94, which is 62.04, will be capitalized. Okay, so this takes care of Ind AS 23. Next you go to Ind AS 40. This is on investment property. So in investment property, you will classify a particular property as investment property if it comprises of land, building or both, which is either owned by the entity or taken under a right of use, where the objective is primarily to earn a rental income or capital appreciation or both, and not for the purpose of own use or for the purpose of sale in the ordinary course of business. That is when it is an investment property. Now there's a gray area that what if the property is held for a currently undetermined use? You're not sure what you are going to do with the property, in which case Ind AS 40 specifically allows you or requires you to recognize it as investment property. Now, whether it is undetermined use or whether you are using it for the purpose of earning rental income, there can be a possibility where subsequently you decide to change the use. You now decide that you now want to, let us say, use it for your own business. In which case, can you reclassify? The answer is yes. Reclassification is permitted, it is allowed, but provided there is an actual change of use. A mere intention in your mind to change use is not sufficient. There has to be an actual change of use. If there's an actual change of use, you can reclassify it from investment property to PP or even vice versa, and this reclassification happens at the carrying value which exists as on the date of reclassification. This is a change of fact, this is a change of circumstances, and it cannot be treated as a change of accounting policy and hence does not require a retrospective restatement. Now this is the background that you have to remember to tackle this question. RTP May 2021. Let us get started. Now X Limited owned a land property whose future use was not determined as on 31st March 2011, which means this has to be classified as an investment property. How should the property be classified in the books as on 31st March 11? If it is land and if the use was undetermined, it will be classified as an investment property as per Ind AS 40. In June 11, that is 3 months later, X commenced construction. So this is an actual start of construction of office building for its own use. So now it is being used for its own use, and as a result now it has to be reclassified to property, plant and equipment. It can be shown as capital work in progress or it is PP, basically under Ind AS 16. Presuming that the construction of office will still be in progress as on 31st March 2012, how should the property be classified by X in its financial statements as per 31st March 12? So it is property, plant and equipment or capital work in progress as a guess. Maybe basically this will be under Ind AS 16. There's an actual change of use. Construction has actually started. Will there be a change in the carrying amount of the property resulting from a change in the use of the investment property? No. Whatever is the carrying value on 30th June 2011 of the investment property will be the carrying value on 30th June 2011. That is the date when the use changes of the PP. Okay. Whether the change in the classification to or from investment property is a change in accounting policy. Okay, a change in accounting policy is a different policy applied to the same transaction. Here, the underlying usage is differing, it is changing, and hence it is a new policy which is applied to a new set of use for the asset. Accordance with Ind AS 8, no, this cannot be treated as a change in accounting policy, and hence no retrospective restatement is needed. In the last year, you will keep on showing it as investment property only. And lastly, would your answer in A be different if there were to be a management intention to commence construction of an office building, however no construction activity was planned? Well, yes, your answer will change. Yes, your answer will change. It will be an investment property only, because a change in usage is the only time where you can do a reclassification. The reason being that ideally the standard mentions it, because otherwise you are using for your own use and now you think, hey, yaar, let us give it out on rent, khud ke use mein kuch ho raha nahi. It is just a change in intention. You are, as a matter of fact, currently using it for your own use. So till the time your actual usage changes, you can't reclassify it as per Ind AS 40 principles. So that takes care of question number 1. Next, you will go to Ind AS 41. This is on agriculture. Agriculture, if it is a biological asset has to be initially recognized as well as subsequently recognized as fair value less cost to sell. Fair value less cost to sell. So while determining fair value, you will take the selling price and you will subtract the transportation cost. If you are aware, under Ind AS 113, fair value is the estimate, is basically the actual quoted price in the relevant market minus the transportation cost. And because Ind AS 41 says you have to measure it at fair value less cost to sell, then even the transaction cost that is going to be incurred in order to sell the asset will also be subtracted. Sir, but then the value at initial recognition, the amount that you are paying may not be equal to the value at initial recognition. Possible. Sir, then where will the balance go? Well, the balance will go to the P&L as loss on initial recognition. At every subsequent balance sheet also, the value might change, and the difference, whether it is going upward or downward, will go to the profit and loss account as a fair value gain or a fair value loss in the profit and loss account. Okay, so let us go to question number 1. Entity A purchased cattle at an auction on 30th June 2011. Okay, cattle is a biological asset. The purchase price on 30th June 11 is 1 lakh rupees, so you must have paid 1 lakh. And the cost of transporting the cattle back to the entity's farm is 1000. So the entity must have paid 1 lakh for buying the cattle and then another 1000 to transport it to its farm. So this is a cost to purchase and not cost to sell necessary. The sale price of the cattle on 31st March 2012, that is probably 9 months later, is 1,10,000. This is the sale price of the cattle. But cattle basically we have to again take it to, let us say, the auctioneer's market. The company would have to incur similar transportation cost. If it were to sell the cattle at the auction, it will again have to incur, let us say, 1000 rupees to sell the cattle at the auction. So this 1000 will have to be incurred in order to sell, in addition to an auctioneer's fee of 2% of the sale price. Achha. So if I were to buy the cattle today and on the very next instant I want to sell the cattle, I will have to sell the cattle through the auction, and the auctioneer is going to charge 2% to sell. The auctioneer charges 2% of the selling price from both the buyer as well as the seller. So maybe when I purchase the cattle, I must have paid 2% to the auctioneer. But when I sell the cattle, I will again have to pay 2%. Achha. Calculate the amount at which cattle is to be recognized in the books on initial recognition as well as at the year end. So at initial recognition, you will recognize the cattle at fair value, which is, let us say, 1 lakh rupees, which is the purchase price, minus the cost to transport the cattle, that is 1000, minus 2% auctioneer's fee on the sale price. Sir, but 2% humne pay kiya, yes, as a buyer, but if you want to sell it, you will again have to pay that 2%, and hence 97,000. This is the cost to sell. This is 2000 you have not yet incurred. However, when you sell, you will have to incur. And transportation cost, sir, you have transported it. Yes, but if you want to sell it, you will again have to transport it back. And hence, these are expenses which are relating to the sale, which you have not yet incurred. However, if you go to see the payment, how much payment you must have paid? Well, 1 lakh rupees you must have paid, plus 1000 rupees you must have paid to transport, plus 2000 you must have paid for the auction, and hence you must have paid 1,03,000. And hence, if I were to pass the journal entry at initial recognition will be cattle account debit 97,000 to bank 1,03,000, and hence there would be a 6,000 loss on initial recognition which will go to the P&L. Just for academic understanding, if after getting the cattle to your farm, the very next instant you want to sell it, you will have to transport it back to the farm, to the auctioneer, and you will have to pay again auction fees, and hence you will get only 97,000. So your journal entry will be bank account debit to, let us say, cattle 97,000 if hypothetically you were to sell it. As a matter of fact, you have not sold it and you have held it till the end of the year, where the value is 1,10,000. However, 1,10,000 you will not get in hand. You will have to sell this by taking the cattle to the market. A cost will have to incur. The question says the company will have to incur similar cost if you were to sell the cattle at the auction. 1,000 rupees. 1,000 rupees, assuming the cost remains the same. Apart from that, the auctioneer will charge 2% from the seller and the buyer. Buyer will have to pay, we don't care, but as a seller, we will have to pay. And as a result, 1,10,000 into 2%. If you calculate, this is I think 2,200, and hence 1,10,000 minus 1,000 minus 2,200 will come to 1,06,800. Acha, in your ledger, the cattle is appearing at 97,000. So 97,000 and 1,06,800, there's a 9,800 upward movement. So this will be at the year end, cattle account debit, 9,800 movement upward to fair value gain. This will be going to the P&L. There is no revaluation reserve, etc. that you create in case of biological assets. You will take it to the profit and loss account. So this is, as you can see, loss on initial recognition is 6,000. The fair value at initial recognition is 97,000, and the value is 1,06,800 at the end. Okay, so this is question number 1. I can rate this as important, something that you should revise. Acha, question number 2 is on similar lines. If you are able to solve question number 1, question number 2 also you will be in a position to solve. Let us go to question number 2. On 1st November 2011, C Agro purchased 100 goats. I think this is a Jan 21 exam question if I am not wrong, but nevertheless, on 1st January or on 1st November 2011, C Agro purchased 100 goats of a special breed from the market for 10 lakh rupees. This is what you have paid, with a transaction cost of 2%. But they have not told whether the transaction cost is paid by the seller, by the buyer, or by both. They have not told as of now. The goats' fair value decreased from 10 lakhs to 9 lakhs as on 31st March 2012. Determine the fair value on the date of purchase and on the financial year end in both the cases. That is, the transaction costs are borne by the seller only. Okay. So if the transaction cost of 2% is borne by the seller, that means at the time of purchase, you must not have paid this 2%. The seller must have paid. And hence your entry in sub point 1 will be at initial recognition to bank. You will have to bank of 10 lakhs. However, your initial recognition of the goats will be at fair value less cost to sell. And if you have purchased today, yes, you have probably purchased by paying 10 lakh rupees. However, if I were to sell it, I will have to, as a seller, incur the 2% cost. So 10 lakhs minus 2%. So 10 lakhs minus 2% will be 9 lakh 80. 9 lakh 80, and 20,000 will be recognized as loss on initial recognition, which will go to the P&L. Sir, हमने अब तक spend नहीं किया. Yes, but you will have to sell, or you will have to spend when you will sell. Okay. Subsequently, on 31st March again, the value is 9 lakhs. However, this 9 lakhs, if you sell it, you will get 2% less. So 9 lakhs minus 2%, and this comes to 8,82,000. In your ledger, something is shown as 9 lakh 80, whose value is now 8,82,000, and hence 98,000 is a downward movement. So over here, your journal entry will be fair value loss, which will go to the profit and loss account, to, let us say, goats, which is 98,000. 98,000. Achha, this is sub point 1 if the transaction costs are incurred by the seller. The second part says if the transaction costs are incurred by both the seller and the purchaser, 2% has to be paid by both. In which case, in the second case, the goat is purchased and the fair value today is 10 lakhs. If I were to sell it, I as a seller will have to pay 2% more, and hence I will still get 9 lakh 80. However, as a buyer, I would not have paid just 10 lakhs today. As a buyer today, I would have paid 10 lakhs plus 2%. So I would have paid 10 lakh 20, and hence the loss on initial recognition will be 40,000. And this loss will be going to the P&L account. Achha. As on 31st March, if I want to find the fair value is or the value to be recorded is the fair value less cost to sell, which is less the amount that the seller has to incur, which is again 2% of 9 lakhs. Buyer also has to incur 2% of 9 lakhs, but that is beyond our scope. We are looking at the cattle that we have. If we have to sell it, we will get 9 lakhs, but we will have to pay 2%. And as a result, we will get 8 lakh 82. Now, if the buyer has to pay something extra, we don't really care about it. And hence, as on the balance sheet date, the goat will still be measured at 8 lakh 82,000, and your entry will still be the same. It will be the same entry. The goat in your ledger was earlier 9 lakh 80. It has to be taken at 8 lakh 82,000, and hence you'll have to reduce the value of the goat by 98 going to the profit and loss account. So that takes care of question number 2. If you have understood question number 1, question number 2 should be understandable working. Okay, both of these questions test your understanding of how you figure out and account for the cost to sell, and in also cases where there may also be a cost to purchase. We are more focused on cost to sell. If there's a cost on purchase, it will increase the loss on initial recognition. It will not really affect the measurement subsequently. Achha. Next you have question number 3, which is a May 21 RTP question, which is based on your understanding of what is meant by agricultural activity and what is the coverage of the standard. So when we look at the definition of agricultural activity refers to two things. It refers to the process which involves the managing or the management of biological transformation. So it involves managing biological transformation, which is the growth, degrowth, etc. Reproduction, managing of biological transformation of a biological asset and its harvest. So harvest includes either slaughtering or plucking. So in case of, let us say, poultry, if you were to slaughter, or in case of fish, if you were to fish out, that is harvest. Or in case of, let us say, nursery, if you were to pluck out the flowers, that is also harvest. So if you were to be covered under Ind AS 41, you should be an entity which is involved in agricultural activity, and agricultural activity involves you having to do manage a process which involves managing biological transformation as well as harvest. Achha, again, agriculture, why are you managing this biological transformation and harvest? Well, for, let us say, either sale of biological assets. So in the business of buying and selling the biological assets, like goats, for example, or for producing agricultural produce. So you are managing the biological assets like cows for, let us say, milk, producing, let us say, the agricultural produce, or you are managing the biological transformation and the harvest for producing additional biological asset, like a breeding farm, for example, for producing additional biological assets. Okay, now when we look at Ind AS 41, agricultural activity, for you to be covered under Ind AS 41, you should be doing some agricultural activity which involves both managing a biological transformation and harvest. Sir, why are you emphasizing on this so much? For example, if I just wake up in the morning, take a fishing net, go into the ocean and try to take some fish, probably I'm extracting the fish for sale of biological assets or producing of agricultural produce. However, I am not doing any activity which involves managing the biological transformation. I'm not feeding the fish. I'm not breeding the fish. It is just, or I'm a woodcutter. I just take an axe, go into the forest and cut a tree. That is probably generating an agricultural produce for the purpose of sale. However, I'm not managing biological transformation, in which case that fish or the wood that I have will directly go under Ind AS 2. It will not be covered under Ind AS 41 because I'm not managing biological transformation. On the other hand, if I have a breeding farm, where I have made an artificial pond whereby I am actually breeding the fish, in which case I am managing the biological transformation of the fish and probably using it for producing additional biological assets, in which case Ind AS 41 will apply. And at the point of harvest, that is when I fish it, the fish will be recorded at fair value at the point of harvest under Ind AS 41, which will be taken as a cost for the purpose of Ind AS 2. Also, if I am, let's say, running an activity of, let us say, maintaining a zoo, or I have a few dogs, which is there in this question, for the purpose of security, well, probably I'm managing the biological transformation of these dogs or these animals in the zoo. Harvest is not one of my major objectives, but nevertheless, I'm managing the biological transformation, and in case the animal dies, I'm probably selling it as well. However, I'm not holding these assets for the purpose of sale. I'm not holding the dog for selling it. I'm for holding it like police people have for security purpose. Same is the case with zoos. I'm not using it for producing an agricultural produce. That is not my main objective. Or not for the purpose of additional biological assets, in which case it does not fall within the definition of agricultural activity. And hence, Ind AS 41 will not apply. So these animals under zoos or security dogs will go under Ind AS 16, held for the purpose of use, but not go under Ind AS 41 because they're not used for the purpose of agricultural activity. The heading of Ind AS 41 is agriculture. It is not just biological assets. Biological assets have to be used for agricultural activity. Okay, so keeping that into consideration, we will go to question number 3. Analyze whether the following activities fall within the scope of Ind AS 41 with proper reasoning. Managing animal related recreational activities in a zoo? No. Why? Because you may be managing the biological transformation or harvest, but you're not doing any of these. You're not selling, you're not holding them for the purpose of sale, not for producing any agriculture produce or additional biological asset, though it may be an ancillary feature that sometimes they might reproduce. However, that is not the core objective for which you are holding these. Like in a breeding farm, that is a core objective. So the answer is no. Second, fishing in the ocean. So this is open fishing. Well, here you are probably producing some agricultural produce. However, you're not managing the biological transformation, and hence the answer is still a no. As you can see, दोनों जगह पे no है. You can refer the reasons as well. Fish farming, that is, you are running a breeding farm where you are breeding the fish and then you are probably fishing them out, in which case you are managing the biological transformation, you are managing the harvest, and you are doing an agriculture activity whereby you are having additional biological assets and you are using them for the purpose of agriculture produce. The answer is yes. Achha, next you have point D. Development of living organisms such as cells, bacteria and viruses. नाम मत लो वायरस का, अपने को वुहान का लैब दिख जाता है. Whatever that purpose was, but if we stick to, let us say, this specific clause, we will have to see why have these been developed. Well, it depends. Your answer, it's not a single answer. It depends. If these cells, bacteria or viruses are for the purpose of sale, you are, let's say, like making yeast. Yeast is something which is used for the purpose of making bread, etc. So if you're using yeast, which is for the purpose of sale, well, then it is covered under Ind AS 41. However, it is for the purpose of, let's say, further research. You are making these cells for the purpose of research, then Ind AS 41 will not apply. Ind AS 38 or Ind AS 16 as a case maybe will apply. 41 will basically not apply. So it's a conditional answer over here. If you go to see, analysis is required. Growing of plants to be used in the production of drugs. So drugs plant se bante? Yes. Maybe if you've seen a television series Arya or something where you have, let us say, license to manufacture opium, which is growing on, which the ingredients grow on trees, which is there for every drug. So ultimately you are using these plants for the purpose of manufacturing. So you will harvest it, and for the purpose of manufacturing drugs, which may be opium, for example, in which case ultimately that is you are managing biological transformation for the purpose of agricultural produce, and this agricultural produce may be used for any purpose, maybe for drugs, maybe for anything else. The answer is yes. It is like you're growing tomatoes for manufacturing ketchup. Well, the activity of managing and growing a tomato farm is an agricultural activity. Okay, and you have purchase of 25 security dogs for 25 dogs for the purpose of security. It's not for the purpose of sale or anything, but for the purpose of security of the company's premises. The answer is no, because you're not doing any agricultural activity over here. So this is quite a deep analysis of Ind AS 41. I hope you are clear with that. So that takes care of Ind AS 41 and module 2 as well. Next we go to module 3, which is with Ind AS 12, income taxes. So over here, this is a November 2020 RTP question. This is the calculation of deferred tax along with a business combination. Whenever there is a business combination, you take over assets and liabilities. So basically net assets minus liabilities, and you take them over at fair value. In case of deferred taxes, you will compare the value as per Ind AS that you have taken over, that is a fair value, with the tax base. Tax base is a value that is appearing in the tax balance sheet. Typically, if a separate tax base is not given, that is when you will look at the old carrying values or the book values in the books of the selling company. You will say, okay, if nothing is given, then the value in the ledger of the selling company will be the same as the value in its tax returns. However, if you have been specifically given tax values, you will take the tax values only. Okay, so in this question, you will have the book values, that is a value in the old company's ledgers, the tax base, that is a value as per the income tax data of the old company, and the fair values, that is a value at which the new company will take over. In which case you will always compare the fair value, that is the value at which the assets and liabilities will be taken over, with the tax base in order to calculate deferred tax. Okay, based on which you will calculate differences, and the general principle is if there is net assets, which is basically an underlying asset, if the assets carrying value is greater as compared to the tax base, the answer is always the opposite, that is a liability. And if the assets carrying value, that is as per Ind AS, is lower as compared to the tax base, it will give you a deferred tax asset. We have discussed this under Ind AS 12, and hence I am not discussing this again. Now the challenge that may arise is, what if there are different tax rates given for the parent company and the subsidiary company? At whose tax rate should deferred tax be calculated? Well, it will always be calculated in the tax rates of the subsidiary company, because ultimately you have to pay tax in the subsidiary's jurisdiction, merely because, let's say, Tata Motors is an Indian company and Jaguar and Land Rover is a UK company. Tata Motors consolidates Jaguar and Land Rover. The tax rate in India is 30, the tax rate in UK is 45, for example. Jaguar cannot say that, okay, I'll pay tax of only 30% because I'm consolidated with Indian company. No, if it is a tax resident of UK, it has to pay tax based on that UK tax laws, whether it is current tax or whether it is deferred tax. And as a result, the tax rate to be taken will be the tax rate of the subsidiary company if you are calculating the differences in the assets and liabilities of the subsidiary. Okay, are we clear with this? Also, goodwill is generally covered by an exception. You do not create deferred tax liabilities on goodwill. This is what Ind AS 12 specifically requires, and hence you will not calculate any deferred tax liability on the goodwill amount. Okay, so considering that, let us go to question number 1. STYK 10 RTP November 20 question. On 1st January 2020, entity H acquires 100% of the share capital of entity S for 15 lakhs. So this is like a purchase consideration, PC. The book values and fair values of the identified assets and liabilities of entity S at the date of acquisition are set out below, together with their tax basis in entity S tax jurisdiction. Okay. Any goodwill arising on the acquisition is not deductible for tax purposes. The question clearly tells you have to ignore. Goodwill is not deductible for tax purposes, so you will ignore goodwill. Will not create any taxable difference. The tax rates for entities H and S are 30 and 40. Okay, this is where it creates a confusion for the students. You will take the subsidiary's tax rate because that is the rate that you will have to pay. So you have been given book values, tax base and fair values. Fair values will be the values as per Ind AS in the consolidated accounts. Tax base is the values as per income tax, and hence since a separate tax base is given, the book value is irrelevant. If it was not given, we would have assumed that the book values are the tax bases. So what we will do is we will try to find the total. So this is 500, 200, 100, so this is 50, 130 less 160, and hence this is 920. This is the total tax base, and the fair values, this is, let's say, 970, 230, 130 and 260. So this is 1070. You are required to calculate the deferred tax arising on the acquisition of entity S. Also calculate the goodwill. So over here your underlying item is the net asset, for which you will first try to find the carrying value, which is the value as per Ind AS as per our steps, which is 1070. Second is to calculate tax base, that is the value as per income tax records, which is 920, and hence you will calculate the difference. The difference over here is 1070 minus 920, which will come to 150, and in this difference the carrying value is greater than the tax base. Whenever the carrying value is greater than the tax base, the answer is always opposite. So if it's an underlying asset, it will create a deferred tax liability. So this is a DTL, which is 150 into, what is the tax rate? Well, if you have to pay tax additionally at a future date, this will be paid at the rate of 40%. And as a result, this is 150 into 40% will come to 60 rupees, which is a DTL. So therefore, if I were to calculate the goodwill, the PC is for 100% stake, which is 15 lakhs. So in thousands, I think all of this is in thousands. So we can just make the change. This is in thousands. So this is 15 lakhs. So in thousands, that is 1500, 1000. NCI is 0%. So that is 0. And then is net assets. Acha, net assets over here is the identifiable net assets. This is at fair value of 1070 less deferred tax liability on a business combination of 60, and as a result this is 1010, and hence the difference between the two will give you goodwill, which is, I guess, 490, on which no separate deferred tax needs to be created. In any case, it is covered by the exception, and over here it is in any case given that it is not deductible for tax purposes. So that takes care of question number 1. Okay, next we have Ind AS 21. Again, this question 1 over here is a fairly old question. I think this is November 19 RTP question, so you might have done this earlier. Nevertheless, I'll just do a quick discussion for this. Question number 1. Global Limited, which is an Indian company, acquired on 30th September 70% of the share capital of Mark Limited. So that gives control. An entity registered in Germany. So this is a foreign company that is purchased. The functional currency of Global is a rupee, and the financial year is 31st March 12. Okay, so over here Global is acquiring Mark, which is a German company, and hence as a part of the acquisition there will be goodwill. Ind AS 21 mentions that goodwill in the foreign currency will remain constant. However, goodwill, like every other asset and every other liability of Mark, will be translated at the closing rate. In a similar way, goodwill will also be translated at the closing rate. It is a requirement under Ind AS 21 which has to be respected over here. Okay, the fair value of the net assets of Mark is 23 million euro, and the purchase consideration is 17.5 million euro. Acha, this is the purchase consideration for 70% stake, which means there's a 30% NCI, and if nothing is given, NCI is calculated using proportionate net assets method. Acha, the exchange rate on 30th September, that is the acquisition date, is 82, and on 31st March 12 is 84. Okay, what is the value at which goodwill has to be recognized in the financial statements of Global as on 31st of March 2012? Acha, over here it will be recognized first in euro. So on 30th of September 2011, you will find the goodwill, which is PC, 70% NCI, which is 30%, unless given using proportionate net assets method. 23 million is the net asset, so 6.9 is the NCI, and minus the net assets. There is no tax rate given, and hence no separate deferred tax working. The PC, I guess, is 17.5. All of this is in euros. Okay, so the goodwill in euros, 17.5 plus 6.9 less 23 is 1.4 million euros. Now this will remain the same whether it is 30th September 11 or this is 31st March 2012. However, if the goodwill has to be converted into rupees on 31st March 2012, like every asset and every liability of Mark, has to be converted at the closing rate as per Ind AS 21 principles for a foreign operation. Even the goodwill has to be converted at the closing rate. Sir, but goodwill cannot change. Goodwill in euros will not change. It will remain 1.4 only. However, if I were to translate it into rupees, this will become rupees 117.6 as on 31st March 2012. So as you can see, the goodwill is 1.4 million in euros, and on the reporting date as on 31st March would be converted at the closing rate. So this is 117.6. Achha, the second part of the question deals with unrealized profit on either upstream or downstream sales. Again, the profit in the foreign currency is determined as on the date of sale. So whenever sale happens, on that date profit is not asset or liability. These are incomes or expenses. As per Ind AS 21 principles for a foreign operation, assets and liabilities are to be converted at the closing rate. Sir, monetary assets at historic closing rate, non-monetary at historic, that is for foreign currency transactions. If there's a foreign currency translation, if you remember, where you translate the balance sheet or the profit and loss, all the assets, all the liabilities will be converted at the closing rate. However, incomes and expenses are converted to the rate as on the date of transaction, and if there is no rate on the date of transaction, at the average rate. You have to be able to differentiate in your mind between foreign currency transactions which you as an entity do with the third parties, and foreign currency translations where FCTR arises, where there is a foreign branch or a foreign subsidiary which you are converting it, translating it into your own accounts. They are two different concepts requiring two different exchange rate workings. Please refer Ind AS 21 if you are confused over here. Achha. So if there is some unrealized profit, this unrealized profit will be recorded at the exchange rate prevailing as on the date of the sale. It's not an asset or liability, it is a sale. And hence, if you have to eliminate the profit, it will be based on the exchange rate prevailing as on the date of sale. Okay. Mark sold goods costing 2.4 million euros to Global for 4.2 million euros. So the profit on this transaction is 4.2 minus 2.4 will be 1.8. Okay, so this is 1.8. During the year ended 31st March 2012. The exchange rate on the date of purchase by Global, that is the date of sale by Mark, was 83 per euro. So the profit, what you are trying to eliminate is the unrealized profit. The profit would be recognized at 1.8 million in the books of Mark, and because the profits are converted at the average rate or at the rate as on the date of transaction, what you eliminate will also be at 83. The entire goods purchased from Mark are unsold as on 31st March 12. So the entire 1.8 million profit, which would have been converted at the rate prevailing as on the date of the sale, will be eliminated. Determine the unrealized profit to be eliminated. So this is 1.8 into 83, which will come to 149.4 in the CFS. So this is, I guess, 149.4 mentioned over here as well. Okay. Next we go to question number 2. Now this is fairly similar to that adjustment for lease that we had discussed, where there is a foreign currency liability. In that case there was a lease liability. Here there is a loan which is measured using the amortized cost principles. Again, the loan is something where you are under a contractual obligation to pay a determinable amount of cash, in which case this is going to be converted at the closing rate, the loan being a monetary item. Interest at the average rate, coupon at the date when the coupon is paid, and if there is a difference, the difference will be due to the foreign exchange amounts. Ideally, if the amortization table tallies in dollars, it also has to tally in rupees. However, it does not tally in rupees because certain amounts in rupees you have converted at the average rate, certain at the opening rate, certain at the closing rate, and hence the difference arises due to different exchange rates being used, and hence a balancing figure has to be taken as a foreign exchange gain or a foreign exchange loss. Okay, let us go to question number 2, please. On 1st April 2011, Makers Limited raised a long-term loan from the foreign investors. Okay, so this is a financial liability loan taken. The investors subscribed for 6 million foreign currency loan notes at par. Okay, it incurred incremental issue cost of FCY 2 lakhs. 6 million of foreign currency notes at par. So 6 million is 60 lakhs. So we have received 60 lakhs against the loan liability. At the same time, we have done 2 lakhs of expenses. If the liability is to be recognized using amortized cost, then this 2 lakhs has to be adjusted from the value of the liability. If it is accounted using FVTPL, then this 2 lakhs will go to the P&L as per Ind AS 109. Interest of 6 lakh FCY is payable on 31st March, starting from 31st March 2012. Okay, the loan is repayable. The loan is repayable in FCY on 31st March 2017. This is 11, so 12, 13, 14, 15, 16, 17. 6 years later at a premium. We don't know the amount of premium, and the effective annual rate implicit in the loan is 12%. So the EIR is given to you as 12%. Coupon seems to be 6 lakhs paid annually at each year, and the EIR seems to be 12%. The appropriate measurement basis for this loan is the amortized cost. Brilliant. So we have been told that this loan is to be measured using amortized cost principles. The relevant exchange rates are as follows. So you have been given on 1st April 2.5 rupees 2.5 per FCY. The average rate is the closing rate is 2.75, and the average rate, if nothing was given, we would have done opening plus closing divided by 2, but if a separate average rate is given, we will take that for the workings. The average rate for the year ended is 2.42. The functional currency is the Indian rupee. What would be the appropriate accounting treatment for the foreign currency loan in the books of makers for the year 11-12? Calculate the initial measurement amount, of the loan, the finance cost for the year, and the closing balance and the exchange loss. All the 4 items have to be done. So what is the method that we typically use? Well, we typically calculate the amortization table in FCY and then also make a similar table in INR. Ideally, the balance in FCY should, if converted into INR, translate into an exact conversion. So if the rates remain the same, then there will be no balancing figure. However, if there are differences, the differences are due to different exchange rates used. So for example, when we look at FCY, so over here 6 million or 60 lakhs is the amount and 2 lakhs is the processing fees, in which case 58 lakhs is the opening value. The effective interest rate at the rate of 12% on that is 58 lakhs into 12% will come to 6,96,000. 6,96,000. The coupon is paid at the end of the year, and the question says that at the end of each year the coupon paid is 6 lakh rupees. So less 6 lakhs, there is no principal paid. It is going to be paid at the premium on 31st March 17, and hence your closing should ideally be, we can actually show it slightly farther away as well, will ideally be 58, 6 lakh 96, and so this is 58 lakh 96,000. Now each of these items you will convert at the appropriate rates. So the opening balance will be converted at 2.5. The interest accrues throughout the year and hence at the average rate of 2.42. Coupon actually is paid at the end of the year when the rate was 2.75 and the closing also at 2.75. So if I were to make these workings in INR, the opening balance would be 58 lakhs into 2.5. So this is 1 crore 45 lakhs. The interest will be 6 lakh 96 into 2.42, which is 16 lakh 84,320. Coupon would be 6 lakhs into 2.75, which is 16 lakh 50, and hence ideally your balance over here should be tied up. So this is 1 crore 45 34 320. This should be the closing balance. However, if I convert 58 96 at 2.75, I'll see altogether a different number, probably 1 crore 62 lakh 14,000. and hence this difference is arising because you have converted these numbers at a buffet of different rates. You have not converted it at the same rate. If you want, just for academic completion, if you convert everything hypothetically at 2.5, you will find that the numbers will tally. जो भी आपका 58.96 into 2.5 आता है will be the same as the closing balance that you get because you are converting everything at the same rate. Here you are converting it at a different rate. In fact, you have to increase the liability, and if you have to increase the liability, so this is 145,34320. You have to increase the liability by 16 lakh. 79,680. So if you have to increase the liability, you have to debit. अच्छा किसको debit करेंगे? Well, in the P&L. So this is forex loss, FX loss, or forex loss account debit to the loan liability. 1679,680 approximately. Yes, this is your answer. Institute has done it slightly differently. Having said that, the ultimate answer should remain the same. Okay, so this takes care of question number 2. Acha, next you go to Index 33. This is a fairly interesting question as well. It's a slightly old question, RTP May 2020 question, but it is a slightly interesting question. Okay, so let's go to question number 1. So over here, before we go into this question, we would want to understand how does the accounting happen. How does the accounting happen in case of ESOPs, in case of EPS, and where EPS we take the profit divided by number of shares. Which profit should be taken? Well, should you take the profit or the comprehensive income? That is, should you include the other comprehensive income? The answer is no. The EPS formula is profit divided by the weighted average number of shares. It could have been comprehensive income divided by number of shares, but the standard clearly tells you it is profit divided by number of shares, and hence other comprehensive income items like FCTR, revaluation reserve, etc., fair value reserve will not impact your EPS calculation. So OCI will not be a part of EPS. Secondly, this EPS is calculated based on the profit available only to the parent, that is the parent's profit plus the parent's share in the subsidiary's profit, or it is the profit of the parent plus the combined profit of the subsidiary. The second important point, well, it is only the profit of the parent plus the parent's share of the profit in the subsidiary. NCI share of profit is not included. Sir, what is the logic? Well, the logic over here is when you take the denominator, you take the number of shares in the parent. NCI holds certain shares in the subsidiary. However, those shares don't enter as a part of the denominator. Well, that means their share of profit should not even enter as a part of the numerator. And as a result, when you calculate EPS, you have to remember that this is the profit which is available to the controlling shareholder. So that is the parent's profit plus the parent's share in the subsidiary's profit. NCI's profit not included in the numerator because correspondingly shares held by the NCI in the subsidiary are not included in the denominator as well. Secondly, it is based on the profit in the P&L and not comprehensive income, and hence other comprehensive income items are not taken. Okay, that is one point, interesting point that you have to remember here. Second point is, this EPS is calculated for what? Well, is it calculated for every item in equity? No, it is earnings per share. It is absolutely clear it is earnings per ordinary share or earnings per equity share, which means if there are other items like irredeemable preference shares or irredeemable debentures which are probably classified as equity, they are not equity shares. They may be equity, but they are not equity shares, and hence if you have paid them any discretionary dividend or any discretionary interest, that has to be deducted. It would have been taken directly in retained earnings because they are equity. However, since they are not equity shares, you have to find earnings per equity share, not earning for any component in equity. And hence, if you are making any payment for any other instrument which is classified as equity, that payment has to be deducted, and those shares like irredeemable preference shares or redeemable debentures cannot be a part of your denominator. They are not equity shares. That is for basic EPS. When you look at diluted EPS, you take into consideration potential equity shares. What does potential equity share mean? Any item which is within equity? No. Any item which has a potential to become equity share is a potential equity share. So something like a irredeemable preference share or a irredeemable debenture does not have the potential to become equity share. It is not convertible, which means it may be an equity item. However, it is not a potential equity share because it does not have the potential to become equity shares. On the other hand, something like a convertible debenture or a convertible preference share may have a liability and equity component, but at the same time, they have the potential to become equity shares, and hence in the diluted EPS calculation, they will be treated as potential equity shares. So a lot of concepts covered over here, probably in a lot of batches that we have done. This sum is already done, but nevertheless, if it is not been done or you have not done this is one of the best questions I would reckon in EPS. So please do revise this. So let us go through question on EPS. CAB Limited is in the process of preparing consolidated financial statements for the year ended 31st March 13, and the extract for the same is given below. Okay. Profit for the year, which is attributable to the parent, that is CAP. Non-controlling interest, this is to be ignored. This entire working is to be ignored. You don't have to take the total earnings including NCI for EPS calculation. You don't take the shares held by NCI in the denominator, and as a result, you will not even. NCI is holding shares in the subsidiary. We don't take the subsidiary shares in the denominator, we only take the parent shares. Again, profit attributed to the parent, yes, other comprehensive income and stuff, well, that is not to be taken. You have to take based on the total comprehensive income. I guess this is also rupees in thousands. Everything is in thousands, 39,000. Everything is in thousands over here in this table. It's written over here, total in thousand. Every number is in thousand. The long-term finance of the company comprises of the following. So I'll solve everything in thousands only. 20 crores, I guess. So I'll just remove the last three numbers everywhere. Equity shares at the beginning of the year, and the company issued another 50,000 in 1,000 shares on 1st of July at full market value. So this will help you in calculating weighted average number of equity shares. Then there is 80,000 irredeemable preference shares. Irredeemable preference shares. These shares are in issue for whole of the year ended 31st March 13, and dividend on these preference shares are discretionary, which means these irredeemable preference shares are in the nature of equity, though they are not equity shares. They are not even potential equity shares. They are just in the nature of equity. 18 crore rupees of 6% convertible debentures. Convertible debentures, they are potential equity shares issued on 1st of April 2011 and repayable on 31st March 15 at par. Okay. Interest is payable annually. As an alternative to repayment at par, the holder on maturity can elect to exchange the convertible debentures for rupees 10 crores ordinary shares in the company. So this is an optionally convertible debenture where the option rests with the holder. On 1st April 11, the prevailing market rate of interest for a 4-year convertible debenture which has no right of conversion was 8%. So this is a market rate of interest of similar instruments without the conversion option. Using an annual discount rate of 8%, the present value of 1 rupee payable in 4 years is 0.74 and the cumulative value is 3.31. So this will help you in calculating the liability component and the equity component. In the year ending 31st March 13, CAB declared an ordinary dividend of 0.1 paise. I just make this rupees per share, and a dividend of rupees, not 0.05 paise, rupees 0.05. That's basically 5 paise and not 0.05 paise on the irredeemable preference share. Okay, this is interesting. Compute the following: the finance cost of the convertible debentures and its closing balance as on 31st March 13 to be presented in the consolidated financial statements, and the basic and diluted EPS for the year ended 31st March 2013. Assume the income tax rate applicable is 25%. I would strongly recommend you to pause the video once and read this entire question and understand the nitty-gritty once again. If you have read this, we will start with the basic EPS calculation. Well, the basic EPS, let us say everything is in thousands, will start at 39,000. Acha, this 39,000 is the profit. Remember, profit will be after interest. So this profit will be after finance cost. After finance cost. So if there's any interest expense on convertible debenture, the word profit typically refers to net profit, and hence this will be after deducting the finance cost. You don't have to deduct the finance cost. However, the profit is before deducting appropriations, which is basically payments to equity, which can be, so this is going to be before the equity dividend, which is okay, but it will also be before the dividend that you must have paid for preference shares. And as a result, if I want to find the profit available to ordinary shareholders, then I will have to take the 8,000 or 80,000 irredeemable. So the preference dividend would be taken directly into the retained earnings. However, if you want to find the profit attributable to the ordinary shareholders, then preference dividend has to be subtracted. So the preference dividend over here will be 5 paise, or that is 0.05. So let us say this is 5 paise or 0.05 per preference share, everything taken in thousands. Acha, sir, but we also have to subtract the interest. Well, if we subtract the interest, we can, we have been clearly given 39,000 as a net profit, and net profit is always after interest, and hence we don't need to subtract this again. Acha, when we look at the weighted average number of shares, that is, let us say 2 lakhs, which is outstanding for the entire year, plus another 50,000 which has been outstanding, let us say, which has been issued in the month of July, and hence it has been outstanding for 9 months. So this is into 9 by 12. So this will come to 39,000 minus, let us say, 80,000 into 0.05, which will come to, let us say, 4,000 divided by, you will have 2 lakhs. I'm just using a slightly different comma notation. So this is 2 lakhs and 50,000 into 9 by 12. So this is 37,500. So this will be 35,000 in the numerator, and in the denominator this will probably be 2,37,000, 2,37,500. So this will be 35 upon 237,500, which will be, I think, 0.147. So this will be 0.147. This will be your basic EPS. Then you go to diluted EPS. Now, if you want to find the diluted EPS, you will have to look at the potential equity shares. A natural instinct over here would be, irredeemable preference shares are potential equity shares. No, irredeemable preference shares are equity instruments. However, they by no means are potential equity shares, because they don't have the potential to become actual equity shares. However, convertible bonds are potential equity shares. However, when you look at convertible bonds, you will have to see the value. So this is, let us say, 18 crores. 18 crores is the value, the total value, out of which you will have to segregate this between the liability component and the equity component. I'm just putting this in thousands again. The liability component will be the present value of all the future cash flows. So your coupon rate is 6%. So this is 18. So this is like 1,80,000 in 1,000 into 6% will come to, let us say, 10,800 into the present value annuity factor at the market rate of interest of similar non-convertible instruments, that is 8% for a 4-year time frame, which is given to you. And since this is an optionally convertible instrument, then even your principal value will be taken into the present value factor at the rate of 8% for the 4th year. So these numbers have been given to you as 3.31 as well as 0.74. So this is 3.31, 0.74. So this is 10,800 into 3.31 M plus 1,80,000 into 0.74 M plus, and you have 1,68,948, which means just for academic completion, the remainder will be the equity component, which is, I guess, 11,052, which is the equity component. Sir, why are we doing this? So that we can find the interest. The interest will be based on the liability component, that is 168,948, and your effective interest rate is at the rate of 8%. So this is 168,948 into 8%, which is 13,516 less the coupon payment. The coupon payment is 10,800, and hence the closing value of the liability component will be 168,948 plus 13,516 less 10,800, which is 171,664. Okay, why did we do this? Well, because in the diluted EPS calculation, we will start at 39,000 minus, we will have 4,000. This is the amount available for equity shareholders. You will start where the basic EPS ended, which is 2,37,500, which is the number of shares. However, if there are potential equity shares, and how many potential equity shares are there? I guess these are 10 crores. 10 crores will come to, let us say, 1 lakh in lakhs. So if you go to see, this 18 crore will convert into 10 crore ordinary shares. So if you take 10 crores on your calculator and divide it by 1000, let's say, yes, that is 1 lakh. So you will issue 1 lakh shares, which will be outstanding for the entire 12 months. But at the same time, you will save the interest. Acha, interest kitna? 10,800. Well, that is a payment. In your P&L, while calculating 39,000, you must have subtracted 13,516. You must have subtracted 13,516. Just a second, you are calculating this for the year 12-13. Okay, so not even 13,516. This is the interest for the year 11-12. 171,664, a very interesting adjustment, because this is the interest for the year 11-12. You are trying to calculate the diluted EPS for the year 12-13. So this is 171,664 into 8% will be 13,000. Will be 13,733 less 10,800. So this is 171,664 plus 13,733 less 10,800 will come to 174,597. So your interest will be 13,733, which must have gone while calculating your 39,000. However, this is pre-tax. Unless given otherwise, you will calculate tax, and this tax will also be calculated based on the interest that has gone in the P&L. For all you know, the tax deduction may be based on some different base, but if nothing is doing, you're solving an accounts paper, which means the deduction for income tax must be based on the interest expense which is recorded in the books. And as a result, this will be 35,000. Sir, we will also add back 4,000. No, you will not, because that is not a potential equity share. It is not even an actual equity share, and hence that 4,000 will be deducted. So plus 13,733 into 0.75 will be, I think, 10,300 roughly upon 3,37,500. So this will be 35 plus 10,300 divided by 337,500 will be rupees 0.134. This will be your diluted EPS as per Ind AS 33. I'll just verify this. 0.147 is correct, and also 0.134. Perfect. So this is a fairly interesting and a deep question. I hope that's clear. Okay, next you have question number 1 on financial instruments. The only question that has been added, this is on guarantee. We have uploaded a very detailed, I think 40 or a 45-minute video on YouTube only for this. So if you want, you can refer that detailed video, and if you have not, please do that. Otherwise, in any case, I'll just do a quick referencing over here. So over here we have the accounting for guarantee. Now guarantee is one of the items which get accounted for under FVTPL accounting, fair value through the profit and loss account. Typically, financial liabilities get accounted for using amortized cost. However, certain liability items get accounted for using FVTPL. fair value through profit and loss. One of them is financial guarantees. So how should the accounting for guarantees happen? Well, at initial recognition as well as at each subsequent balance sheet date, it will be recognized at fair value. And how do you calculate the fair value? Well, this is based on the present value of the coupon savings that are generated due to the guarantee. It is like saying that if you as an article clerk go to take a loan, probably the bank is going to doubt your credit worthiness, probably you don't have enough income to repay the loan, and as a result, if the bank has to lend to you, it will lend to you at a higher rate. However, if you get the backing of someone who is fairly accomplished, who has a lot of credibility in the market, if that person gives a guarantee to you, the bank will be rest assured. The bank would say, well, even if this article clerk is unable to repay the loan, because it is guaranteed by, let us say, Mr. X, who is capable of repaying the loan, the bank is going to lend to you at a lower rate. And as a result, the interest savings that are generated are due to the guarantee given, and hence the fair value of the guarantee or the guarantee commission that would be charged would be based on the present value of the interest savings that are generated in the future on account of the guarantee. So this is how you will value the guarantee at initial recognition as well as at every subsequent balance sheet. However, if there is a guarantee liability, you also have to remember that there is a possibility that the debtor might default. And because of that, so if you are the grantor, if you are Mr. X who has given the guarantee, you should ideally be receiving the guarantee commission. Like when banks give guarantees in letters of credit, they do get commission. So if you are giving the guarantee, you should receive the commission. If it is not received, then probably it's an off-market transaction. You will have to look at the nature of the transaction, but ideally you should receive commission. And if you have not received it, you will look at the nature of the transaction on why that is off-market and what is the reasons. However, at every subsequent balance sheet, you will remeasure the guarantee liability at fair value, which is based on the present value of the remaining interest savings. If someone were to give the guarantee, let us say after 1 year, how much would be the guarantee commission that that person will get? That is one aspect of guarantee. However, you have to also be cognizant of the fact that the principal debtor might actually default. And if the principal debtor defaults, you will have to make a payment. And as a result, there is a potential loss allowance. So you will have to compare the fair value of the guarantee with the potential loss that you are looking at and select whichever is higher. So basically the valuation at each balance sheet date will be the fair value of the guarantee or the loss allowance, whichever is higher. And the differences between the opening and the closing balances will be accounted for using FVTPL principles, that is, it will go to the fair value. So this is a summary discussion. For a detailed discussion, you can refer the YouTube video separately uploaded on this topic as well. Let us go through this once. So over here we have question number 1. On 1st of April 2011, Sun Limited guarantees a 10 lakh rupee loan of subsidiary Moon, which bank STDK has provided to Moon for a period of 3 years at 8%. Okay, so this is your actual coupon, which is 8%, and the amount of the loan is 10 lakhs. The interest payments are made at the end of the year and the principal is repaid at the end of the loan term. If Sun had not issued the guarantee, bank SDK would have charged an interest rate of 11%. So because of the guarantee, there is a saving of 3%. Sun does not charge Moon for providing the guarantee. Well, ideally Sun should charge, right? However, it appears that there is a holding subsidiary relationship, and due to the holding subsidiary relationship, it is not being charged. Okay. On 31st March 2012, that is 1 year later, there is a 1% probability that Moon may default on the loan in the next 12 months. If Moon defaults on the loan, Sun does not expect to recover any amount from Moon. So whatever is lost is lost. But there's a 1% probability it will default, which means there's a 99% probability it will not default. Okay, on 31st March 13, there is a 3% probability that Moon may default on the loan in the next 12 months. So the probability increases. If Moon defaults on the loan, Sun does not expect to recover any amount from Moon. Okay, fair enough. Provide the accounting treatment for the financial guarantee as per Ind AS 109 in the books of Sun and the initial recognition and subsequent periods till 31st March 2013. Okay, so guarantee is one of those items which is going to be accounted for using FVTPL. So on 1st of April 11, if I were to find the fair value of the guarantee, that is based on the present value of the future cash flows. Because of the guarantee, had there been no guarantee, then the coupon at the rate 11% would have been 1,10,000. Well, the repayment would still be 10 lakhs. And with the guarantee, the coupon at the rate of 8% would have been 80,000. The ultimate repayment at the end of the third year would still be 10 lakhs. And hence the savings that are generated, a cash outflow avoided is similar to a cash inflow, are 30,000. This is 30,000 for year 1, 2 and 3. There is no savings on the principal. So what is the opportunity cost for the person who is taking the loan? His ability to raise money is at 11%. 8% to iske liye ho raha hai because guarantee, but otherwise his ability to raise the money is at 11%. And hence if I were to find the present value, this is 30,000. You can even take each number separately, or you can take the PVAF at the rate 11%. That is his cost of funds for a period of 3 years. So this is 1 divided by 1.11, 1, 2, 3. So this comes to around 2.4437. So this is 30,000 into 2.4437 will come to 73,311. So ideally Sun Limited should receive a commission of 73,311 because that is the value of the letter, the guarantee that it has written. However, because it is given to a subsidiary, nothing is charged, and hence at 1st April 11, the entry will be investment in subsidiary. This is an off-market transaction because of the holding subsidiary relationship. So that is investment in subsidiary account debit 73,311 to, let us say, guarantee liability, to guarantee liability. This guarantee liability will be again 73,311. This is a guarantee which under Ind AS 109 is going to be accounted for using FVTPL principles, and hence as on 31st of March 2012, this has to be measured. This guarantee has to be measured. Investment will remain as it is. However, the guarantee has to be measured at fair value. And how do you measure the fair value? Well, based on the present value of future cash inflows or future interest savings. Well, the loan was for 3 years, out of which 1 year has already gone by. So if someone were to give a guarantee at the end of year 1, that is on 31st March 2012, one would say that, well, because of this guarantee, I'm helping you save interest. Well, for how many years? For the remaining 2 years. For the remaining 2 years. And as a result, this is going to be 30,000. However, this is 30,000 saved on 31st March 2013 and 31st March 2014. So this is PVAF at the rate of 11% for the remaining 2 years. 1 divided by 1.11 equals to. So this is 1.7125. So if we multiply this is 30,000 into 1.7125. So this is 51,375. Alternatively, so this is what you say is still unearned income, or this is still the liability. So ideally you gave a guarantee whose value was 73,000. At the end of year 1, we can say that ideally this 73,000 will be recognized as income over a period of 3 years, because this is like unearned revenue. You have received 73,000, but that is for a guarantee over 3 years, out of which 1 year has gone by. At the end of 1 year, the value would still be based on the present value of the future cash flows. There is an alternative way in which you can find this 51,375 as well. Institute has shown that alternative way, but it results in a bit of confusion. But nevertheless, this is the value. Or what if moon defaults? If moon defaults, there will be a loss. Moon defaults, if moon defaults where there is a 1% probability, then the loss will be the entire 10 lakh amount. However, if it does not default, there is a 99% chance and your loss will be 0. So for academic completion, you can say plus 99% into 0, in which case this amount is 10,000. So you will recognize a liability at the higher of the two, which is 51,375. And hence at 31st March 2012, you will say that the liability in your books is 73,311. However, it should now be 51,375. So the liability should reduce, and hence you will debit. So this will be let us say guarantee liability, guarantee liability account debit. So this will be 73,311 minus 51,375, which is 21,936, to FVTPL, to let us say fair value gain or guarantee income, whatever you call it, which goes in the profit and loss account, 21,936. Sir, is there any other way in which you can get this answer? Yes, you can prepare an amortization table. So what you're doing over here is either 73,000, which is at year 0, 73,311, which is at year 0, you take it to year 1, or the values at year 2 and 3, you bring it back to year 1. So what we have done is we have taken the future interest savings of 30,000 and taken it back to year 1. What institute has done is, the institute over here has prepared an amortization table, and it has said, okay, this is year, this is 1 where the opening is 73,311. Let us say the effective interest rate at the rate 11% would be 73,311 into 11% will come to, let's say, 8064. Let us say the effective coupon will be 30,000 over here, the savings, and hence the closing, if you calculate, will be 73,311 plus 8064 minus 30,000, and you get the same number, 51,375. So if you are going from Bombay to Ahmedabad, the distance, let's say if Surat comes somewhere in the middle, you can measure the distance of Surat from Mumbai, or you can measure it from Ahmedabad. It is like saying that when you are looking at moving from year 0 to year 1, so if you want to find the value at year 1, either you can find the value from year 0 to year 1, like what the institute has done, or you can take year 2 and year 3 and take the present value back to year 1. You will always get the same answers. Just that in the institute's method, the challenge is students always say, okay, this is guarantee liability, it is going to be accounted for using FVTPL. How is there an effective interest rate? There should be no effective interest rate. You look at the institute's journal entry as well. They have not passed any entry for effective interest rate. They have not passed entry for interest expense using amortized cost. And hence, this creates a little bit of confusion. If you are clear with the institute's working, stick to that. Otherwise, you can follow the working that we have done as well. It will result in the same answer. Acha. So now your guarantee liability after this entry comes to 51,375. You go to 31st March 2013. Again on 31st March 2013, the fair value is the higher of the present value of the future cash flows. So this is the present value of the future cash inflows or future interest savings. Well, at the end of year 2, there is only 1 year which is remaining. So if someone were to give the guarantee at the end of year 2, we would say that, well, you will help us in saving interest for 1 year only, and hence the value is into 0.9009. So this is 30,000 into 0.9009, which is 27,027. Or sub point B, you will compare this with the loss allowance. Now you think the probability of loss is 3%, so 10 lakhs will be lost, and that is a 3% chance. However, if there is no default, there is a 0 rupee loss, for which there is a 97% chance. So basically this is 30,000. This is higher of the two, which is 30,000, and hence your liability should come down to 30,000. So again on 31st March 2013, your entry will be your guarantee liability account debit, guarantee liability account debit, which is, I guess, 51,375 minus 30,000. Your liability has to come down. So this is by 21,375 to, let us say, fair value gain, which you can take it into the profit and loss account. 21,375. Acha, if at the end of year 4, the question does not tell you that, at the end of year 3, the next year, the debtor repays the loan, in which case this 30,000 which is there in your ledger will go to the P&L. So ultimately over a period of 3 years, 73,311 went to the P&L. However, if the debtor defaults and you have to make a payment, then whatever payment you make, so guarantee liability will be debited to bank, and whatever is the remainder will go to the profit and loss account. So this is the journal entries. Let me just see. Starting you get 73,320, approximately the same number. You will debit against the investment in subsidiary because it is an off-market transaction. At the end of year 1, 21,935. 21,935, approximately the same answer. We have 936 will go to the P&L, and at the end of the second year, 21,385. Apna 21,375 will go to the profit and loss account. So that should take care of financial instruments. Next, we are going to start with module 4. So probably we will do that in the last video. So we will stop for the time being, and then we will continue with the next video where we complete the module 4, discuss the amendments as well as discuss the conceptual framework. Okay? So I'll see you in the last video, and we will complete the new sums section there. Okay, thank you very much, and I'll see you in the next video.